Hi everyone. Yes, attendez tout le monde, voilà. Hi everyone. So thank you for joining this webinar on Act Finance. During the next 60 minutes, we'll present to you Act Finance, which is the latest methodology developed by Act Initiative. Its aim is to spot the strengths and areas of improvement on financial institutions with regards to the Paris Agreement contribution. I'm Stanislas Rey. I work at ADEM since beginning of 2023, and I will make this presentation together with Arthur Dietrich, who joined ADEM for 6 months for an internship. We'll join also by Victoire and Simon that will handle the technical aspects and chat moderation of this webinar. Some rules to begin. So if you last the few first minutes, or if you have IT issues or anything, do not be afraid, because the presentation will be recorded and available. Slides that will be presented also will be sent and made available after the webinar. Given that you are more than 300 who have subscribed, we have deactivated mics and cameras. So feel free to add your questions, to ask questions in the Q&A section, or if you do not have Q&A section because you do not use Teams usually, you can ask questions directly in the chat. Where possible, it will be addressed during the presentation, and if not, we have a Q&A session at the end of the webinar. So what we will tackle today. So first of all, for those who are not familiar with the ACT initiative for which we are working, there will be a presentation of what it is and what it can bring to your financial institutions, because beyond ACT Finance, as you will see, other pieces of the ACT initiative might be relevant to develop your climate strategy. Then we will make a presentation about the context of ACT Finance and why we have developed it. We'll go then after under an overview of the ACT Finance methodology itself, before going through a look through on the testing and results that have been provided, because the methodology has been tested on a panel of 25 financial institutions last year. And then we'll go through the follow-up. I wish you will have a pleasant webinar, and I let the floor to Arthur in order to present the ACT initiative.
Yes, so hello everyone, thanks for being here with us today. So for some context, ACT is an initiative which is several years old already. It was implemented after the Paris Agreement, founded by ADEM, CDP, French Republic, has some strategic partnerships such as World Benchmark Alliance that you can see at the bottom. You see the list of financiers of the projects on your screen. And the concept of the initiative is to create a context of climate accountability, a framework to assess companies' strengths and weaknesses and help them build their transition plan with regard to the Paris Agreement. If you look at the little red square, you see that there is build and assess. So ACT is declinated in two very distinct methodologies. One which is ACT step by step, which helps build the transition plan, and ACT assessment, which helps evaluate the transition plan. We will go into the details right now. So how does a journey of a company in transition work? The first condition, which is before ACT, before us, is to measure, so to do carbon accounting. So we have quoted a couple of protocols that you can respect. We for everyone who's familiar with the BGS, this is a requirement for to be part of the ACT journey. And then comes our methodology. So the first one, as we said, ACT step by step. So to help build an ambitious decarbonization strategy. And the second one, which is ACT assessment, which helps evaluate existing transition plan, its strengths and weaknesses against Paris Agreement objectives. So in the specific context of a financial institution now, how can you use ACT? So you can use ACT to engage, to evaluate your counterparties, and to evaluate yourself. So engage by using ACT step by step. So all the companies, all the investees, the people that you have lent money to, that you're involved with, you can engage them by suggesting them to use ACT step by step to build a relevant and ambitious transition plan. If they already have one, you can already evaluate their transition plan and their climate maturity in general by using ACT assessment. That's where all the different ACT methodology come into account, and we will explain them in a moment. And you can use the evaluation process, for example, to integrate them in an investment policy or for your risk management policy as well. We're specifically thinking about exclusion policy as well. And last but not least, to evaluate yourself as a financial institution. That's the methodology that we're going to talk about today, ACT Finance, to spot your own strengths and weaknesses in your climate strategy. Moving on. So to give you some context on every ACT methodology, you can see that there is a number of them. They've been developed throughout the years, and the latest babies are banking and investing, which have been developed for 2 years plus. And you can see that there is, so those methodologies are sectorial, which means that it applies to each sector has a methodology. So we've started with the most climate material sectors. And there is also cross-sectorial methodologies, such as ACT adaptation, ACT generic, in case you want to evaluate something that doesn't fall under any scope, and ACT biodiversity. And I'm going to finish by giving you some context on how ACT evaluation works. So it entails 3 different dimensions, 3 different scores. Let's be honest, the most relevant one is the performance score. That's where the heart of the methodology is, and that's where the complexity of the methodology resides. So you have 9 sub-modules, 9 indicators, which are weighted according to their relevance for the specific sector that you're on, which evaluate holistically and completely the climate maturity of the company you're assessing. And this performance score is complemented by a narrative score, which is more about quality, which is more about all the variables that you could not entail in the performance score, which give more context, a more general context. And lastly, there is a trend score, which is basically if you're doing the same evaluation again in a couple of years, are you expecting an improvement or a degradation of the grade? We have worked on that, so I mean, we'll explain everything later. So you need to keep in mind that ACT is composed of 3 grades, of which the most important is the performance score. And now I'll give back the voice to Stanislas to explain more context on the birth of ACT Finance.
Thank you very much, Arthur. So getting this context, we go back to the Paris Agreement. So it's really a methodology that is oriented as the other methodology to which way your company is aligned to Paris Agreement. So back in the Paris Agreement, we have a role for finance as a whole, which is to make financial flows consistent with the pathway toward a low greenhouse gas development. So there is a need of reorienting financial flows. And to this extent, we put here a study from McKinsey dated from last year. Private investor households have a significant role to play. So financial institutions in general have a power and a significant role to play in this reorientation of financial flows. So it's not just through public policies and state-owned enterprises that the work will be done. We really need an embarkment of financial institutions themselves. However, how to reorient this role? So we put it from a European Union perspective, but in other areas of the world, we might have the same idea, meaning that many regulations have popped up with the idea to foster the transformation and reorientation of financial flows. However, it does not be on themselves an operationalization of the reorientation, meaning that all these methodologies, they are helping financial institutions, they are providing information, but they do not in themselves explain exactly to the financial institution how to reorientate their financial flows, which is good, which is bad. So this is quite a difficult situation because financial institution needs to develop themselves and think themselves about how to do the orientation of financial flows and how to contribute to Paris Agreement. With this regards, there have been, of course, financial institutions committed themselves, notably through something like the JFENS initiative. But we have some concerns popped by several actors regarding the credibility of some financial institution commitments. Here I put two examples with, you can have the hyperlink. The first one is a non-governmental organization, Reclaim Finance, which was criticizing the setup set by the Science-Based Target Initiative regarding financial institutions, claiming it was not going far enough. Of course, it's an NGO with its agenda and it's challenging, quite pushy. So, but there are also different actors with a different tone. So we found a paper from the European Central Bank itself that was explaining, that was trying to look on the portfolio data and trying to assess whether when you make commitments versus when you don't make any commitments, do we see any difference? And the paper was saying we almost at the moment do not see a significant difference between people that would be committed and people that wouldn't be. So all of this create a context where it is a little bit hard to have clarity on the topic. But we need financial actors to play a role in the real economy by shifting the financial flows. How to do that? It's not obvious at the moment. So disclosure is not enough, that's for sure. That's the lessons learned from the previous, all the regulations that can be put in the previous years. Therefore, there is a need for a tool and methodology that assesses and screen the financial institutions' climate strategy in order to provide visibility and credibility to stakeholders. And this is done, we specify it with a point of view of reaching Paris Agreement, where that matters. That is what matters on point of view. How we did it? So, we have the existing ACT framework that Arthur explained to you later on with these 3-dimensional 9 modules, and we started from that framework that was adapted for real economy sectors that are actually polluting themselves. We adapted it to finance specificities with the core idea that when I finance polluting sector or polluting activities, I do not pollute myself. I have a responsibility. But on the other way, if I just sell off my high emitting pollutions, my high emitting position, I do not bear any actual impact in the real world, maybe a second order price signal, but that's it. So given the situation, we need really to specify and to adapt the framework of ACT to the reality of what is financing and focusing on financing flows rather on judging emissions themselves. To do so, we are not alone. So we looked at the literature, we looked at what is done currently today, and notably you have some examples of source of inspiration, so JFENS work, UNEP work, taxonomies, and so on and so. And in the end of the day, we came up with this ACT finance methodology, which is a comprehensive assessment of a financial institution decarbonization strategy and transition plan. So really, this is not just a measure or score of portfolio alignment. This aims at assessing the company globally, and we will see how in the next slides. How we issue the methodology, we have a common process to any methodology and in ACT initiative. So we gather technical working group. Here we had 2 technical working groups, one for banking activities and the other for investing activities, because we believe that since it's 2 different positioning in the financial institution framework, they have 2 different levels. So there is a need to develop 2 methodologies. There have been meetings, consultations, and a first methodology issuance that was submitted to public consultation beginning of 2023. Then we insist on the importance to make actual tests on a real case. So this is what we call the road test. So we hired a panel of volunteering financial institutions. We complemented with some public assessments in order to check whether it was possible to perform the assessment of ACT Finance. This was done in 2023 with assessment and reports provided. That helped us to spot what had to be changed, and we had the time to make reassessment beginning of 2024 and to publish the final version of the methodology in May, which leads to our webinar as of today. Further steps will be explained later on, but we have a training that is under development, and of course, ongoing methodological changes that might occur. I will let now the floor to Arthur in order to explain, to dig in the methodology and explain the principles.
Yes, let's go. So now let's talk about the actual deal, about the actual methodology. Hope you're excited. So first of all, you have already access to the methodologies on the website. So there are two methodologies, banking and investing. The differences will be explained shortly. They're very small. What's the interest of going on the website outside of reading 250 pages of delicious PDF is that so there's all the literature reviews and all the choices that were made, the assessment construction, the rationale, the explanation behind the weighting systems, the explanations behind the boundary of the methodology. Those are very detailed information that we invite you to read. And if you have any questions, you're always welcome to challenge them. Bear in mind that this is the fruit of extensive work, and we're very proud of that. So feel free to have a look at that. Moving on, let's explain to you the scope of the methodology, the perimeter of the methodology. So starting with banking, we'll move to investing in a next slide. What does the Banking Act Finance Evaluation Methodology cover? So it covers lending activities mainly, commercial and retail. It excludes government loans, as you can see in the absolute middle. And it also includes capital market activities, so all market facilitation activities. And you here have the detailed list. So corporate loans, SME loans, and for consumers, mortgages and auto loans, excluding personal loans, such as prêt à la consommation in French. And yes, so basically, all loans exceeds government and including capital market activities. Moving on to investing. So for investing, it's also not as tricky as it could sound, because again, we include almost everything excluding government fixed income, so government debt and bonds. So to quote a number of them, equity, private equity, venture capital, and also real estate portfolios as well. And no further elaboration on that. Again, if you want to read the absolute detail, you have the PDF accessible, or feel free to ask us any question or contact us by mail later. So how is the methodology structured? We mentioned briefly the 9 modules earlier. Let's dive a bit deeper in them. So this table works the following. You have some quantitative and qualitative modules. Some modules are exclusively qualitative, and they all have a different weight. You can already see that some modules are more important than other ones. So which one are the most important ones? For starters, module number 4, climate portfolio performance. That's really the core of the methodology, and that's where most of the points will be awarded, and that's also the most challenging module to score on. Stanislas will explain how later. Then module 1, the module on targets. That's also one of the most material ones. We'll come into the details later. I think, Stanislas, you can push a button which will put all the explanations on the modules. Yeah, perfect. And module 7 is also very material. So here we have a bit of an explanation on all of them. So let's go through them briefly, and we'll go in detail in module 1 and 4 later, and you're welcome to ask any questions on any modules during the Q&A time. So module 1 targets, GHG and non-GHG targets, also everything including exclusion and the scope of the targets. Then module number 2 is usually material for general act in other sectors, but not for finance. We chose to exclude material investment into the finance methodology, and that's a very important point, because we think that doing some scope 1 and 2 optimization for a financial institution should not be a relevant should not be, it's not relevant for its final climate footprint and climate strategy. So we choose to exclude it entirely to focus on scope 3 emissions and financed emissions. So yeah, material investments, scope 1 and 2, not relevant for the methodology. If you want, you can assess it by ACT real estate, which is a different methodology, different purpose, and there you can assess your climate efficiency. Then module 3, immaterial investment. Here we focused on the employee training. So the amount of time, the quality of those trainings, the percentage of employees trained within the organization. And then module 4, we'll go into detail of that, but basically climate portfolio performance. Then module number 5, management. So the governance structure, management incentive, climate risk management, scenario studies, and yeah, the existence of a transition plan is relevance. There are 6 sub-indicators on that module, which are all explain whether the company grasps the importance of climate problems and is structured to tackle those problems. Then module number 6, investor savers engagement. One of the few nuances between methodologies. So we hope that as a financial institution, you have processes in place to engage your counterparties and also your savers. It's not as relevant as module 7, which is investee and climate engagement, because what would matter most for the climate is not so much to engage your savers, but mostly your lendees, your investees, and your engagement framework with your investees is also a very material module, with module number 7 scoring at 20 to 23%, depending on the methodologies. Then number 8, policy engagement, which is everything about public image, public positions on climate hot topics, and the association with trade associations, lobbyism. And lastly, module number 1, business model. Even though a business model of a financial institution is pretty telegraphed, we look a bit in the nuanced whether it's built for climate resilience. Moving on how, I would like for Stanislas to explain to you what we think, as the person who developed the methodology, that an optimal climate strategy is like for a financial institution. So Stanislas will share his experience on that.
Thank you very much, Arthur. So the idea, you have a presentation, let's say a plain presentation of the methodology itself. Now another way to express it and to sum it up is to see, okay, what is, in our view, the ideal setup of a financial institution's climate strategy that actually contributes to its best to the contribution to the reaching of Paris Agreement. And the idea would be that your situation will be scored against this ideal situation. And this can explain to you then easily where you have improvements to make or where you are already good. So we try to sum this up, with this circle. The first step in our view is to categorize your portfolio. I mean, you have a portfolio of people that are invested or financed or serviced. The idea is you need, in order to say, I contribute actually to the transition to Paris Agreement, I need to have a view on whether these companies or these activities are actually transitioning or low carbon or not. So it's kind of an analysis framework you need to set up, or you need to ask somebody that is relevant to do it for an external provider or something like that to provide it to you. And in the end of the day, to set a clear categorization of your portfolio. And you have an example that is provided here, meaning a guy that is actually transitioning, a guy that is already low carbon, but on the contrary, a company that is not transitioning, whether it should be, or a company that does not have any significant climate impact, so it's not really a big deal. This categorization of your portfolio is really the heart from which you can leverage your climate strategy. Meaning, first of all, management of risks and impact. So with that, you can, of course, a company that is not transitioning should bear transition risk. So from a risk perspective, you would intend it to set limits, to set a watch list, for instance, Or on the other way, you can also say, okay, thanks to this cartography, I know who is good, who is bad, and I can express, for instance, financing targets in order to express in a positive way my commitment to reaching Paris Agreement and reorienting financial flows. Thanks to this, I can make a commitment on financing targets, or I can communicate on how much I allow to the transition. This setup of management of risk and impact, it's not static one. It can express later on through an engagement. Of course, you will use your power of influence as financial institutions to engage your companies. Mostly, you can use a carrot or stick approach. With the stick, you can spot on the not transitioning companies or companies that are only partially transitioning. And you can say, okay, thanks to our analysis, we know that you are good there, but we have improvements to make there. And you can set up in place a stringent engagement process. Which is really important is to say that in order to be credible and have an impact, this engagement process cannot just be a chat once a year. It needs to have a credible escalation process, which can lead to eventually exiting the business. You can also, from a positive way and a carrot approach, say, you are not alone, we can help you. And as a big financial institution, notably, you can develop services and tools to help companies improve themselves and, for instance, set up a transition plan. At the end of the day, all of this complexity, we'd like to sum up that it can be simplified and sum up as a simple binary of I finance or I do not finance. This is really important in the methodology because the module 4 indicators that we will go further later on is exactly based on this principle. You can, for instance, set up a process where the decision of financing a guy that is not transitioning is made at a higher level. So this actually changes your own organization, and it's really something from your perspective. But from the perspective of reaching Paris Agreement, if the flows have been provided, or in the other way have not been provided to climate solutions, it doesn't change anything. So it's really important from an impact and reaching Paris Agreement perspective to understand that what matters in the end is the orientation of financial flows. We will now go through a deep dive on the main mechanism of the methodology. So Arthur will present the qualitative aspects of it, and as well as module 1, and I will cover module 4. Arthur, floor to you.
Yes. So to explain to you a bit of a technical explanation of the methodology, how it works within the methodology, how the assessment is performed. One of the core tools we used is the concept of the maturity matrix principle. So here's an example. As you remember, most modules were qualitative, and even in the quantitative module, some qualitative aspects were playing a role, and that's what we're using here. So how does it work? We're asking a key question about the financial institution, any aspect of it really, and then there are different levels of possible maturity, hence the name maturity principle, maturity matrix. And depending on how mature, how strong the organization, the company is, it gets assigned a grade from 0 to 100%. There is detailed descriptions that you can read to help that the evaluator, the assessor can read to give a very accurate and precise answer. And to the right, you see the weighting that this specific question has within the indicator globally. What's great about those maturity matrices is that they really guide you for the answer. So even if sometimes you lack a bit of context on a specific aspect, the methodology will guide you. And also it can serve as a potent consulting tool because it can help you assess what you could have done differently if you wanted a better grade, or what's your next step, or we were really short on scoring less, but thanks, we did this and that. So it's a real guidance tool for decision making and understanding the strengths and weaknesses. There's a lot of these within the methodology, and they're really explicative. Moving on. We're going to start talking about more technicalities. Here we'll gain the detail of module 1. So everybody who's a bit familiar with climate targets here will understand what we're talking about. So you can already recognize for the SBTI fans the little table below, the little graph that we'll come to in a second. So how does module 1 works? At least module 1.1, because there is there's 5 sub-indicators in module 1, but the most important one of them is module 1.1. So GHG targets. We're gonna assess the quality of the target, and then we're gonna contextualize it by several different scores. So how do we do that? We look at a reference scenario that is comparable with the targets. Usually we use AIE1, so Agence Internationale de l'Énergie for my French speakers. And we compare the target on whichever specific benchmark with the associated scenario. And we see whether there is a commitment gap or not. So whether the target that the financial institution has set is indeed compatible with a 1.5 Paris Agreement world, or it's missing something, or if it's even better than that. Usually the targets are calced on the benchmark themselves. So that's where it's pretty easy to score all the grades, because you just have to speak a commitment. You just have to make a commitment. So that's where the graph comes from. You just assess whether there is a commitment gap between the target and between an associated benchmark. So that's for the commitment score. And then we'll move on to the next slide, where we'll contextualize this commitment score, this easy to obtain score, by the details, by other indicators. For starters, we look at the credit coverage score. So what is the volume of your portfolio? What is the volume of your credit lines that is being covered by the target? Usually, this problematic is not even mentioned when the target is set. The financial institutions are not even aware that this is at stake. They don't even realize that, oh, realistically, this target will apply to 60% of our portfolio. So as not to penalize and put a zero here, we usually have fallbacks within the methodologies by about like 67% or something like that. So you see, you're already losing 1/3 of your mark here. So that's the first contextualizing element, credit coverage score. Then we have the GHG coverage score. So what percentage of emission of that benchmark is your target covering? Is it covering every relevant emissions? Is it omitting some? For example, if you look at the automotive sector, if you put a target on the automotive sector, whether the quality of your target, the GHG coverage score of your target can have a tremendous influence on the relevance of the target. Because if you cover only production but not useful life, you're missing some part of the emissions that are absolutely relevant. So again, if the topic is avoided altogether, we have a fallback. Sometimes when financial institutions formulate a target, they don't even bother contextualizing it by those things. So we have a fallback of, depending on the sectors, 60 to 80 to 50%, something in those range. Moving on, the data quality score. So how reliable is the data that you're basing your target on? We use PCAF. So some of you might already be familiar with it. It's actually some form of industry standard, is becoming some form of industry standard slowly for data quality. And the score PCAF ranges from 1 to 5, usually being in the middle at 2 or 3 from experience. Again, a possible way to lose marks. We know that realistically, it's impossible to get a perfect PCAF score, because there is, especially at the moment, the data frameworks reporting are not as mature as they would need to get a perfect score. But we put that in order to nudge the financial institutions in the right way and to teach them to be exigent with their counterparties about their data quality. So we hope to see improvements in the future years with all of that, specifically since a lot of reporting frameworks such as CSRD are coming up. And lastly, we have the target category score. So the target unit is critical for the target to be relevant. Some financial institutions try to hide behind monetary targets, and that will lead to a degradation of the mark. We prefer physical or absolute intensity targets. So I think monetary target is worth what, Stanislas, 67 or 50% of the mark?
50%.
50%, right? And physical and absolute intensity will grant you the entirety of the mark for that contextualization score. The idea, again, is to nudge the financial institutions into becoming exigent, into becoming rigorous. So it could be a bit penalizing for less mature institution, but that's what the message we're trying to convey here. And lastly, the sectoral adjustment. So the benchmark, as I said, is put on a specific sector, or if the benchmark is if the target is globalized throughout all credit lines and all sectors, it will not be worth as many marks as it could have been if it's sectorally declinated. But the most common thing we've seen so far are sectoral benchmarks, so per sectors, and not every sector bears the same responsibility in polluting the planet. So for each sector, we will ponderate the target's mark by its climate materiality. So this table, Stanislas, could you explain a bit how you've developed that 80% here, 2% there?
Yeah, of course. So the issue, as explained by Arthur, is that all the sectors do not bear the same responsibility. One solution we could come up with is to say, okay, to aggregate these targets and to say, okay, the target on cement versus the target on auto sector, how do I mix them into one scoring? Could be to rely directly on the GHG emissions disclosed by the financial institutions. But as said by Arthur before, there is a global issue at the moment on the reliability of GHG data, because you are, as financial institution, quite dependent from counterparties. Therefore, it could be not so much reliable. For instance, if financial institutions has just completely forget one parameter for one or other reason, waiting through the GHG emissions could lead to completely different results depending on the methodology of each financial institutions. Therefore, we came up with something robust, which is to assess at global level thanks to IPCC data, thanks to NGOs and stuff like that, a global contribution of the sector. So, for instance, you have a coal as a. It's not to be interpreted as a physical contribution. It's more an intensity of contribution. So, coal is at 27%, for instance, and agriculture will be at 18%, and aluminium at 2%. What does that mean? That means that a target on aluminium will have 9 times less weight than a target on agriculture. And this way, we will be able to aggregate the score of each target of different sectors, bearing in mind that we keep more weight on, for instance, on oil and gas targets. Usually, this is favorable, of course, for financial institutions because in a sound target design, they will focus first on the most material sectors, so the ones that grant more points. I think I will just, this is done for GHG targets.
Yep,
and we
perfect.
can, yep. Okay, so we can move on.
Yeah, everybody who already, this has become a bit more technical now. So I invite you to write down on a paper already in the chat every question you have, and we'll take them later for the Q&A. So as to make the discussion the more interactive possible in the last half an hour of the presentation. And now, be ready, it will become even more technical, as Stanislas will explain what I personally think is the most interesting part of the methodology, which is module 4, climate portfolio performance. So hope you can pay attention to that.
Yeah, thank you very much. So again, as said in the global picture, the intention is, in the end, is we focus on the orientation of financial flows. So what we look at is not so much the actual decrease of GHG emission. We will look at in module 1, but not so much in module 4. In module 4, we look at the financing. Basic idea is, okay, if I want to contribute actually to Paris Agreement, I need to finance those who need it for transition, and I need to stop finance climate damaging activities on those who are not moving to transition. Quite simple. On the first part, the non-financing activities, the way we look at it is to look at the financial flows versus the fossil fuel sector. The way we will look at it on the financing part, we will come it later, is through the concept of low carbon transitioning share. On the first part, this is dimension 1 and 2 of the 4.1 indicators. We have a binary approach, quite simple. In case you continue to finance non-transitioning fossil fuel assets, you get 0 points. In case you finance transitioning fossil fuel assets only, you will get some points. This is quite simple, quite robust, quite abrupt, but in our view, it is consistent with scientific consensus, and we will see later on, we might have some improvement to make to this, but at the moment, this provided quite satisfactory results. So regarding the coal, we look separately at the coal and the oil and gas sector. If the coal, you invest in the coal, you will get 0. If you get not invest in the coal, you will get 100% of the point of the sub-indicator. On oil and gas, we will consider the concept of transitioning company. If you say, look, I finance oil and gas, but only companies that I believe, me as a financial institution, that I believe that are transitioning, we will grant you part of the points depending on the quality of the assessment you made. So we will commit later. So non-financing part, we look at the 4 last year of have you financed or not these sectors? If yes, is it transitioning or not? And then you have a simple 0 or 100. Just to pay attention that the weight of this indicator on the global score is less than 5%. Moving on to the financing part, which is the dimension 3, we have this concept of low carbon positioning share. Ideally, this idea is if I contribute to the financial, if I contribute to Paris Agreement, 100% of my portfolio, of my monetary flows to people that are transitioning and that help them to transition or that are already compatible with the low carbon world. So the idea, assuming that we have, you are able to display to us what is the transitioning share of your portfolio, 100% of the portfolio transitioning would grant 100% of the point, 50% of the transitioning portfolio will grant 50% of the point. That's quite simple. Now, because this is some new concepts, we complicated a little bit the thing by installing a dynamic. This is what you see in the graph. So we look in the past, in the 4 years in the past, on whether you have a dynamic of financing activity. So you can start from very low, but growing very fast. And this will grant you plenty of points, even if the position score at the end of the day is not so much relevant. So to do that, we put an hypothesis that is quite arbitrary, quite robust, which is in order to reach in 2050 global neutrality, we need 20 years before, meaning in 2030, to have 100% of the portfolio that is transitioning. And from this assumption, we can deduce a simple linear relationship where, in this example, in 2019, we are at 3 or 4%, and you can derive the linear progress that needs to be made year after year in order to reach 100% in 2030. And then we basically do a comparison of areas. So here you have an example where there is a progression that is quite tedious. So we make a ratio between the blue area and the orange area, and this delivers a trend score. You have the maths that are developed here associated to this example. In the methodology, it is further developed with pedagogical examples, step by step, how it works. But basically, the idea is the more you finance transition, the more you get points. The more you finance quickly transition, the more you get points. Now we come to the key question. I assume that you are able to demonstrate and to disclose what is the transitioning part of your portfolio. And the reality as of today is most of financial institutions do not have any idea or barely some start of ideas, for instance, green bonds investments or stuff like that. We are in a fragmented world where, as presented before in the context, nobody is telling you, okay, I have a world registration and held by United Nations saying this company is good, this company is bad. It does not exist. So we need to cope with uncertainty on the topic. So how we do in order to assess anyway the transition share, we implement a combination of standard approach and own financial institution assessment. The standard approach first, so some people have think about what is already a low carbon activity, what is a transitioning company. For instance, from your perspective, you have the green bonds standards that has been issued. And of course, from transition, this is the own purpose of the ACT initiatives and the 15 methodologies presented before by Arthur is exactly to display, okay, is this guy transitioning or not? And we have a categorization paper that is explaining a little bit when you have a good grade, you are transitioning. When you have a bad grade, you are not transitioning, and that explains it a little bit more. So this standard approach allows you to screen your portfolio and say, okay, I know the ACT rate of this guy. I know that this is an EU GPS. Okay, I know that this is low carbon, this is transitioning. But this is not the only initiative in the world, and we do not cover any company in the world. So we need to complement this, and to complement this, we use the analysis framework of the financial institutions. Meaning that if you are a financial institution that you claim you want to commit to Paris Agreement, that you want to be aligned, you should have an idea of what is transitioning assets to you. So you should have developed internally an assessment of, according to you, what is a company transitioning in a credible and robust way, what is a sustainable investment, what is a climate credible investment. So we just ask the question to you, and then we will grade it through a maturity matrix. So basically, when you have no definition, which is a pure black box definition, you will have 0% of the point. When you have clear definitions that encompass all the relevant concepts, we will go it later on, you will have full part of the points. And these factors, they will influence the final scoring. Meaning, for instance, if I have 40% of transitioning share, but that is recognized assuming definitions that was 50% in terms of quality, I will have 40 divided by 2, I will have 20% of scoring. This way to do is not optimal, but it allows flexibility and recognition of the current framework where nobody is clearly telling you who is good, who is bad. So in order to assess who is transitioning or not, we need to rely on your own analysis. If we look a little bit more on the principles we use to verify that your assessment framework is good, we will basically it will be the 9 modules of ACT, but phrased in a different way. We look at, does the company have targets? Does the company have a decarbonization strategy with clear levers? Is it organized through the management in a proper way? Does the company, where it's relevant, engage its value chain? In terms of lobbying, is it consistent? And is there a reporting and verification process set at the company level? All these principles, set in a less funny way, are categorized in this table that is extracted from the tool. We try to say what is very, very important, what is a priority. And we consider that, for instance, tier 1, setting a target approved by the management and the relevant parameter is really the minimum, basically having a SBTi validity target. What is very relevant also is in tier 2 to get identification of lower decarbonization and stuff like that. And then we have, which is important but less relevant, in tier 3. And this way, we come up with a maturity matrix that is saying the best qualitative, the best assessment framework we can have is an assessment framework that is encompassing 1, 2, and 3 criteria described below. So we will ask you, what is your definition of transition company? We will screen it with this maturity matrix, and this will give you more or less points. So when you have all the criteria, you will have the most of the point. Only tier 1 and 2 criteria, 75. Only tier 1 criteria, basically you consider an SBTi validated target, 50% of the point. And then when you have nothing at all, we have 0%. And we have a 25% category for situations, for instance, where a consultant is coming to you, it provides a tool, but you don't really know how it works. You're not so sure it's even purely climate, but there is something. So we consider a little reward for that. And I want to stress it really because assessing transition plan is really the heart of everything as a financial institution. We are, this is the situation as it is, but everybody is talking about assessing transition plan at the moment. And it is very important to have standardized principles across the world so as to avoid fragmented opinions on the same company. So if with ACT you come up with a rating and with another assessment you come up with another rating that is totally decorrelated, you have an issue of consistency. So it's really important that everybody strive in the same direction. And therefore, we put an highlight on this part could be a little bit modified because we are looking at everything that is done on standardization level. And we would like to put your attention notably on the work performed by the WBA NGO that is coordinating a work on the transition plan and that has currently issued a consultation paper on framework and guidance to assess the credibility of a company's transition plan. So we are waiting for the end of this paper and the consensus it can reach or not, and maybe we will update a little bit further our methodology. But the core principle will remain the same. We believe this will be second order changes. Moving on now to the testing part. So this was all we can say about the methodology itself. In the slides that will be provided after the meeting, you will have one slide dedicated per indicator. And during the question, do not hesitate to ask a focus on some or the other module. Now we will look at the road test. Regarding the timeline, so just a quick recall of the timeline here. So the test was conducted in 2023. We gathered the volunteering of roughly 25 financial institutions of various profiles, so investors, banks, universal banks, small banks, universal investors, specialized private equity, for instance, investors of various profiles in order to test the methodology. So this the work has been done also through the year 2023. At the end of the year, we get feedbacks and insights of what to change in the methodology. So we spend the first part of 2024 to do methodological updates and to reassess the panel in order to check that the changes bring the expected behavior. If we look at the feedback, so this is the ratings before the methodological changes. So this is what you can look in the web test reports that we have published recently. On banking, first of all, so grade is on 20. So you see that the grade is 5.6 on 20. What we can look at as usual insight is for module 1, usually, so you have GHG targets and non-GHG targets. On GHG targets, as Arthur said, usually targets are aligned when they exist. Targets are aligned, however, the contextualizing elements, do we have a good credit coverage, a GHG coverage, data quality stuff, and so and so. Most of the time, the information was missing. So the lack of contextualization led to some decrease in terms of the rating. And furthermore, you have, as non-GHG targets in this module, you have some screening of exclusion policies. And there we had some weaknesses also. Other relevant point is the module 4, where we can see that the maturity was very low. So median and mean of are very, very low, 5 and 10%. This reflects the fact that as of 2023, when the test was conducted, most of financial institutions did not have a clear analysis framework of transitioning company. So of course, no framework of analysis, no possibility of recognition, and no points in the methodology. This, we believe, will change in the coming years. So those are the main points in terms of management and policy engagement. It was a bright side of the test. It was overall solid. And an engagement strategy, most of the time, as we said in the methodology, we aim for a really stringent process with clear escalation process up to possibly the exclusion of the exiting of the business. And this most of the time is lacking. So this will diminish the score received, as well as issues of perimeters or lack of formalization of the client engagement. On the investing world test, it's overall the same messages. Some nuances can be brought. Regarding the targets, is usually there is less target setting in investing side. It's less frequent that there are some sectoral targets. Banking are most prone to design sectoral targets. And then module 4, you can see here there's this one company that was scoring particularly high. This was the test of private equity, small companies that was really focusing on transitioning assets. So the idea here was, of course, to check that this was working properly, and actually it gets some good grades. Leaving the floor to Arthur, maybe for the lessons learned and main changes from this road test.
Yeah, sure. So after reevaluating, after we've done the road test, we have adjusted the methodology. So in adjusting the methodology, we have noticed that first, our philosophy was validated, the methodology was working. You can, Stanislas, put on the entire slide, will be fine. So first, we realized that we were on the right track with the methodology. We were assessing what we wanted to assess, and it was giving an appropriate picture of the financial institutions. However, we were sometimes too punishing for things that we were just being mean for the sake of being mean. And we don't want to make everybody feel like we're elitist specific for absolute climate leaders, but we want to engage everyone. So we decided to show more progressivity and acknowledge more efforts when they were being made by adding intermediary steps and avoid over penalizing. So for example, when I was mentioning in module 1 earlier, maybe they don't even have that GHG coverage aspect covered. We decided for the haircut to be less penalizing Either way, when a company doesn't have processes in place, it's reflected in the grade, but let's not, when efforts are being made, let's not be the most penalizing. Let's be encouraging and inclusive. And so that's why overall the tool is more non-progressive. And we also improved the ergonomic of the complicated Excel. Right now it's a 49 Excel, it's a 49 sheet Excel file, which will likely be implemented in an online, more user-friendly tool. And everyone here who has already done an ACT methodology, you already know what to expect. And after, so how does those things translate specifically to the methodologies? You can move on, Stanislas. For the banking methodology, no, sorry, for the modules, we have adjusted. So for example, the module number 1, let's process module by module. There is more intermediary targets, and we have decided to be more critic on module 1.3 or 1.4, which is exclusion policies. We have realized that more often than not, the exclusion policy, we were being too laxist with the exclusion policies, and we decided to really put the finger on them. Then moving on to module 3, we really accepted to focus on exclusively climate training of the employees. If you have done other ACT evaluation for other sectors, these modules can be more complex. Here, we decided to simplify it to reflect the most material aspects for a financial institution. Lastly, moving on module 4. The module 4, it was more technical reshaping, so adjusting some weight here and there, and simplify some. For example, there is a taxonomical fallback if you targets are set. If your targets are set taxonomically, so we made some simplifications for that, so as to be less technical and more visual, more intuitive for the evaluators and for the purpose of analyzing the evaluation later. So module 5 and 6 went through barely any changes. And then module 7, we reshaped the weighting so as to value a bit more the strategies and the actions to involve the investees. And to sometimes they were a bit too theoretical, but even if they're still nascent, we decided to valorize them more, and so as really to encourage everybody to put something here. And lastly, we did basic reshaping for module 8, and then module 9 was reshaped because it was originally just adapted from other ACT methodologies, but for specifically for the finance sector, we needed to reshape it entirely to focus on transformative measures. So we're looking for something a bit disruptive with your average financial institution that really nudges towards climate progress here. That was the conclusion for module 9. And we decreased the weight to 5% for module 9. And lastly, the only thing that's left to talk about is how those changes have been implemented into the re-evaluation. We did a re-evaluation to the light of all those changes, and Stanislas will show the results of the re-evaluations of the road tests.
Sure. So all in all, we were expecting a slight improvement because the idea against what we find that all the haircutted we put were relevant in their concept, but too punitive, setting everybody at the same time. So in the end of the day, we get a slight improvement of the rating. So we get, for instance, for the banking 5.6 to 6.3. Main changes as the discussion. So for targets, we had a reshape of an indicator that was not so much that was too punitive, and all this easing of the contextualizing factors led to an improvement of the TIG size of this module. However, on the other side, as presented by Arthur, we add some question about the exception of in exclusion policies, and this led to a decrease of rating. So overall, there was a slight improvement in this module 1. Module 3, you have a big improvement because there is an indicator that has been dropped regarding the research and development, because it's not relevant. It's relevant, but it was very hard for financial institutions to discriminate what was actually a climate research and development in their costs. So the indicator was not efficient, and we just chose to drop it. And as there was almost no information, the fact to drop it gave more weight to the first indicator on training, and it led to an improvement. Module 4, the reshape and the better recognition of qualitative steps led to an improvement also. On management, we had quite an easy question that was dropped because it was basically who was variable remuneration, is it the top level or not? And it was always the top level. That was not very discriminating. So we chose to drop this question. That led to a little bit drop. And then overall, we had some different changes. Please note that in business model, it's really a reshape of the model, so there's no real comparability. On investing, you have the same behaviors, basically. One exception, notably on module 4. So we would have expected an improvement of the module 4, but here we looked that there was some mistakes that were done in the previous assessment. It's due to the economy of the tool, where when you put nothing in the tool, it was granting you some points. This has been corrected, and therefore you have this decrease due to that. But overall, the investing have the same behavior. In order to, we already reached 60 minutes. So on the conclusions, all the scores of this test, that is of course partial and are not representative of all the market, and to this extent, notably, it's not possible to make direct comparison between banking and investing population because the population was too different. So even if investing have slightly better grades, you can say directly that investing are more ahead of banking. It does not work like that. It's more broad messages. So the score, they are low, but they reflect, in our view, the global maturity of the market. So as said, no categorization framework, no recognition, no analysis, or at least formal analysis that is set in the processes of the financial institutions of whether the companies are transitioning or not. This is crucial. And in terms of engagement process, most of the land and exclusion policies, we see many little lines that weakens the ambition and the parameter of these exclusion policies, and that weakens the associated score. However, we're expecting improvement in the future. So as said before, transitioning assessment is in our view the hot topic. So GFANS has issued a paper of categorization. CBI has issued, I believe, a first tentative of operationalization of what does that mean to be aligned. Ourselves at ACT have delivered a categorization framework based on the ACT scoring. So there is a convergence, and we hope that the financial institution will be able soon to have a screening, an actual screening of their portfolio. Furthermore, from an EU perspective, you have the CSR list coming, and that, notably on module 1, will display many compulsory points, and that will bring the contextualizing information that was missing at the moment. And what we believe is in all this work in the future that our methodology will contribute to pave the way with this underlying vision we share with you, alongside with all the other initiatives. To this extent, just to note that we were pretty happy to be acknowledged by the Institut Louis Bachelier that published recently its alignment cookbook 2 that was comparing various methodologies regarding the issue of portfolio alignment. The next step is also we have a recall of what happened in the past. So at the moment we publish the results. What we intend to do in the second part of the year is to develop the ACT Finance training so that consultants or financial institutions themselves can be trained to this methodology and propose it to other financial institutions to auto-assess themselves. And in the midterm future, we expect some ongoing methodological improvements. So we spot some areas. We had the definition of a transitioning assessment that can lead to further convergence. We can make a little bit of reshape in the fossil fuel. We can think also about extension and from some personal loans and stuff like that. We have some things in the bag, but at the moment it's quite a piece of information already. I will let the floor to Arthur for the conclusion.
Yeah, so thank you everybody for paying attention for the last hour. And before reaching the Q&A, we just wanted to for you guys to interrogate yourself of what you can draw from today, what you can do with all the information you got. So moving on to next slide. You're likely either from a financial institution or a consulting firm, or just anybody who's curious, right? And what you can do now is already consult the methodologies online, or train yourself on either ACT assessment, ACT real economy, or the ACT real economy. You can slowly make the things pop. Train yourself on. All right, so yeah, let's roll back. So what we talked about today was how to evaluate transition plans, right? And how to enable people to build a transition plan. So if you remember from the early stages of the presentation, it's exactly what our two methodologies are doing. ACT evaluation to evaluate transition plans, and ACT step by step to enable someone to build a transition plan. So you can be trained currently to ACT real economy methodologies, and the ACT Finance training will be upcoming soon. You can pre-register to it if you want. There will soon be a list that you can join to pre-register it. And you can train yourself on ACT step by step. It's already doable. If you want, you can also, as a financial institution, contact a consultant, or if you're a consulting firm who's already educated on ACT assessment, real economy, you can contact financial institution and offer them the service of conducting ACT assessment for their investees and for their counterparties, and even offer them an ACT step-by-step to build a transition plan if it's within your financial institution's priority to have in portfolio companies with relevant and stringent transition plans. And doing all of that, you as a the goal here is to provide financial institution with a risk management framework, some possible green products, and stringent engagement strategies for its counterparties, stringent exclusion strategies, and realistic financing targets. So those are all the benefits, or including yourself within the ACT environment. Would it be for ACT real economy or ACT finance, as well as ACT step by step? So thank you everyone for paying attention. You can click the different links with the presentation that will be made available to you. The replay will be made available to you as well. And we invite you to ask all the questions you have in mind for the last 20 minutes-ish, and we'll be happy to take them. So yeah, let's take a breath for a second, and we'll come back to the questions. While everybody thinks, Stanislas, do you have anything to add on top of that?
No, I think there's already some relevant questions that have been asked, and I think I can maybe cover one of them. Looking at the Q&A section, so Sylvie, you asked, beyond the methodology, is there an intent to attempt to publishing individual banks rating? The answer is clearly no. The idea is a road test, so they were volunteering. I'm not so sure.
Yep. Could you re-speak the question out loud, slightly slower, so that non-French speakers could understand what the question was?
So beyond the methodology, is there an intent for them to publish individual banks rating? No, because part of the deal is you come to us with an unfinished product. So you have a free assessment, but it's non-finished product. And the aim is not to do a name and shame. It's for us to really test our methodology. And if you counterparties that have been assessed can use it to improve yourself, that's all for the good. But we do not want to make a name and shame. And it's ADEM philosophy globally at the moment is always to accompany and help companies improving, and not name and shame it. So maybe in a few years, when everybody is at 15, we will be glad to publish it. But at the moment, the idea is not to send bad message. It's just global maturity of the topic is quite low, but we hope there will be improvement in the future, and no question to name and shame anybody. If we look on the conversation itself, I just take from the end. What is your assessment of the ACT finance methodology upcoming uptake by stakeholders? Do you envision could become a benchmark widely used tool? And what would be the incentive to use it? Okay. This is in a prolongation of it. At the moment, nobody is keen to pay to have a bad grade. Some are, but they are very virtuous. So I believe it's at the moment we make this methodology because we believe that the underlying this there is strong messages and behaviors that need to lead in the right direction. We will issue a training so people can use it. We will see two ways of doing it. So first, financial institutions want to assess themselves in a more progress way, and they know they will not maybe net so good grades, but it's not a problem for them because all they want is to learn about themselves. Either we can have third parties that wants to make assessment and benchmarks. So WBA, for instance, could do at the moment is doing benchmarks in real economy sectors, could be interested to do some benchmark on financial institutions. The incentive for the asset manager would be to show, I think, transparency and volunteering to improve itself. Usually what is done in the ACT initiative framework is we go for the ACT evaluation because it scores the principles, and then we do an ACT step by step in order to say, okay, how a company that is starting from the ground, how can I help the company building a sound transition plan? So in the future of this ACT assessment finance, we may build an ACT step-by-step methodology that will help more precisely financial institutions to build a sound transition plan, and then they can be assessed by ACT assessment and check that there is actually a good score. It is very important to go to the ACT assessment before, because it is ACT assessment that brings the ultimate goal and the progressivity. If you do not make the ACT assessment and if you go on the step by step from the start, you won't really know where you're going. I hope this answers the question. Why give such a high weighting to the target score, considering this is mainly a communication issue for the investment fund? It's an interesting question. So just as a recall, but maybe there is some link in the appendix where we can do that. Yeah, we can get it there. You have here the disclose of module 1 through the different indicators, and you can see what we call GRG indicators are covering only the three first indicators, so it's only 11%. It's a little bit more than the half of the module. So actually, on the 20% rating on the module 1, you have 10%, 11% only on the GRG score. So actually, this is not the main thing, indeed. But we believe it's still relevant to have monitoring and GRG emissions, because even if you can, through methodologies or just through in and out, manipulate easily the carbon footprint, overall, it's a lagging indicator. It's a relevant lagging indicator that allows to check that there is an actual decrease. And notably for universal bank or big asset managers, in the end of the day, you invest in all the economy. So all in all, you cannot hide any more GRG. At the end of the day, if there's a decrease, it's probably that the underlying economy is decreasing. So we believe this is still relevant, but for 11% of the point. And the remaining 9%, we had no time to look through, but it's screening exclusion policies, looking if you have some transition plan coverage targets, for instance, or if you have some financing targets. Question, what is the reason that led to not include personal loans in the scope of the methodology? Yes, so the question is actually relevant. So at the moment, we believe that we cannot link the loans to an underlying asset that we could monitor the GRG footprint. Furthermore, there is a part of the time with personal loans a question of social. A social question was the people who is lending money is in difficulty. So this is concurrencing somehow the environmental aspect. So for these various reasons, at the moment, it is not included, but we know that some people are working on an efficient carbon footprint estimation of this parameter. And maybe in the near future, we can extend the parameter to that. We had a question also on investing in fossil fuel issuer only via green bond instruments, how it is assessed. This is a very relevant question, thank for it. So two things. The issue with green bonds is always, so you have the guarantee that your use of proceeds will be used for green products. But if you look at the global way, at the global organization, you could say that this will free this globally non-transitioning organization. This will release it with more capacities to finance on the other side with non-green bonds, climate damaging products. So we have this issue. How we treat it in the methodology we have an assessment of what is a green bond. So we focus mainly on what is the maturity matrix for assessing the transition plans. We have the same for assessing low carbon activities. So what green bonds referential are you using? If you're using something very stringent, so for instance, the EU green bond standard will be quoted quite well. If you're just using this is a green bonds, but it does not follow any kind of standardized initiative, it won't work so much. What is important is for green bonds to get maximum points is that the issuer itself is considering transition. A green bond that respects all the standards, but that is issued by a guy that is itself not in transition, will get only part of the point because of this difficulty that this might be just a financing twist to relieve him and allows it to invest even more in climate damaging activities. So the recognition of the green bonds will be made through dimension 3. It will feed the transitioning share. And regarding the fossil fuel financial flows as seen in dimension 1 and 2, if I can go back a little bit more on that, it will, for coal, it will provide 0. It doesn't count. So if you are able to finance, to have a coal company that is issuing green bonds, anyway, it will be provided 0 in this dimension. This is something we might not work a little bit on it, but at the moment it's done this way. And if you invest in an oil and gas, green bond oil and gas, we will grant you the points that worth the quality of the green bonds, meaning that you invest only in green bonds issued by an oil and gas that worth 75% in terms of maturity metrics, you will get 75% of the points. Further question, comment on slide 25. Okay, I'm not that far. Okay. Sector adjustment weight not redundant with incitation to use scope 1, 2, and 3 for all investments. The idea here is to no, there's no double counting. It's just a question of in a situation where I have a target on cement and a target on automotive sector, how do I mix those two targets in a single score? So the idea here is to provide a view on what is the most important. So there's no additivity. We normalized here, the coefficients are normalized because, of course, in each of these sectors, you have scope 1 plus scope 2 plus scope 3. So the idea, this is why I said it was not a physical interpretation of it, it was just orderly, is to say what is the intensity, what is important. If I add scope 1, 2, 3 of coal, if I add scope 1, 2, 3 of electric utilities, and so on and so. What is the relative importance, and this helped me to aggregate all the data. But it's not aggregating GHG emissions, it's aggregating and mixing, making a weighted average of scores. So there is no double counting. You can have its technical points, you may have some further insight in the methodology. And of course, you can come back to us if it's not clear. Is there any further question? Yes. What are the most efficient value reduction target investments companies can have? Absolute value, carbon intensity, combination of the two. So best for us is absolute or physical intensity in relevant sector, of course. So you have homogeneous sectors such as cement, you have heterogeneous sectors such as chemicals. It's not possible to have intensity per liter of chemical products, for instance. But this is really something that is that copes with a physical interpretation. Then, so these are the best. Then you have two kinds of monetary targets. You have the carbon footprint and carbon intensity. I always missed who is who. One is on ton of CO2 per million of unitary units invested. So it's very relevant, notably for an open fund, which is dependent of its collect. Now, of course, if the open fund have 3 times more assets, of course, it will have an increase of its targets. So it's quite fair that the investment fund displays targets under this feature. However, the issue is that you can have significant moves due to purely financial effects. For instance, my equity next 50 is gaining, and up magically I have a decrease of my intensity. So due to these issues, this kind of target is haircutted. So to come back, it's 75% on this one. And the second kind of monetary target is the carbon intensity, which is a ton of CO2 per million unitary units of turnover. And this is very efficient from a financial point of view because you can mix all the sectors, all the companies into one weighted indicator. But honestly, on a physical interpretation and what does that mean, it's really hard to do so. So this target is assessed with a 50% haircut. So to sum up, absolute and physical intensity, carbon footprint, carbon intensity. And I think that's all of it, unless I missed some questions.
Yes, there is a question from Sylvie again about how the methodology is being received by the banks, and how do we hope to reach the industry beyond the national borders.
The feedback received from the panel of volunteering financial institutions was overall good, despite the low rating, because it was explained that why you have this low rating. It's all the purpose of it is not just you have a low rating. It's this is why you have weaknesses. This is why we can improve. Globally, so it was quite fine. We had some criticism on some aspects. We had some criticism on some aspects, and we tried to cover them in the methodology changes, notably more progressivity. So more progressivity in the methodology because it was too harsh to say, okay, you're bad there, you're bad there, you're bad there, and you make a haircut on haircut on haircut. It was not possible, so we eased that, and I think it's quite well received. The most negative, let's say, comments, unfortunately, were made, and the feeling is were made by the people that were the less regarding within the methodology. So it unfortunately didn't allow us to improve our methodology. Saying that, we are aware that we are not perfect. Nobody is. This is a complex question, and we know that we need to work still on some aspects. So, for instance, the transitioning. The concept of transitioning coal, for instance, is not recognized, whether in some areas, for instance, in Southwest Asia, it might be relevant. So we need to work on this thing. There is another part of the question, if I remember.
It's how to reach the industry beyond the national borders.
National borders. How to reach industry? Yeah. What we do is this webinar, we present the methodology. We get some relevant insights from some people. We present it before this webinar to several people that were interested in the concepts. We had some chat also with supervisors because you have in Europe you have this issuance of presidential transition plan. Even if the perspective is different because it's purely a risk perspective, one could see that there is always porosity between risk and impact because your impact can translate into reputation risk. And furthermore, we strongly believe that the fact that financial institution needs to set up transition plan analysis is key both for impact and risk. I do not see any other comment. The interest is that you will get the presentation at the end of the day. You have our contact if you have any further question. We will be very happy to exchange further with you because we know, of course, there is still room for improvement, but we're quite happy of what we have achieved so far, but looking for improvement in the future. So with that, I think we will finish 5 minutes ahead. So. Yeah.
Another question just arrived from Gabriel Kilshore, asking if there will be a step-by-step adaptation plan to include the finance methodology in
we start the discussions. Yeah, it's a very relevant question. We start the discussions. This is mostly an issue of resources and the public agencies that we are. So we'll see how it goes. But hopefully we get one. So for those in the right time zone, I wish you a pleasant lunch and pleasant end of the day for all the others. I hope this helped you and see you later. Bye.
Thank you, everyone. Bye.
Thank you very much.